Good afternoon, everyone. This is Kim Schmidt, Executive Editor of Farm Equipment Magazine. Welcome to our latest webinar in conjunction with the Western Equipment Dealers Association. Today's presenter is Karl, Chief Market Strategist at Corpay. He leads Corpay's currency research group focused on analyzing shifts in the world economy and creating strategies that help businesses harness market volatility. Before we get into the presentation, just a few housekeeping items. On your screen, there's a control panel with a Q&A icon. You can submit questions here at any time during the presentation, and then time permitting, we'll look to answer as many of those questions as possible. And just a reminder, the webinar is being recorded and will be shared with everyone who registered in the event that you want to go back and rewatch it later. All right, we are ready to get started. Thanks again for joining us, and you can take it away, Karl.
Thank you very much for that kind introduction. So definitely great to see so many of you on today. Definitely very interesting time in currency markets, to say the least. I think so. Today I've talked to reporters about what's happening with the Brazilian real, what's happening with Russia's potential default, and all of the bond procedures that have to go on there, the Canadian dollar, and what's the other? Oh, and oil prices so far today. So yeah, it's extremely turbulent times in financial markets. Lots and lots of uncertainty. So today I wanted to talk with you a little bit about, the broader themes that are happening out there. Some of the bigger, sort of fundamental changes that aren't just impacting markets today, but have been in place for decades, and really, are being accelerated by the onset of the pandemic. So before I get started, I just wanted to sort of give you a dose of humility. So John Kenneth Galbraith, one of the sort of most influential economists ever, said the only function of economic forecasting is to make astrology look respectable. So wanted to kind of, set that out at the beginning here. We're going to talk a lot about what is going on in the global economy, and how that might impact interest rates and currencies. But at the end of the day, what I'll really be trying to do is to identify some of the risks and some of the, turning points that might be ahead. Trying to tell you exactly what's going to happen in the future would be a fool's game, and would not be something that you should rely on. So just keep that in mind. So the overall topic we're going to talk about today is money, the volume of money that's available to global markets and to consumers and businesses, and the cost of that money. So as many of you know, we have been living in an environment for a very long time of extremely abundant money, huge volumes of money in global markets, very, very, very low interest rates, and very lax credit conditions that have enabled the economy to grow in a very interesting way. But it's kind of important to highlight that this is not the first time that we have seen a cycle like this. This sort of thing has happened many, many times in human history. If you go back through, Roman documents, for example, or even Egyptian documents, you can see evidence of a credit cycle, a cycle that does not necessarily match what is happening in the underlying economy, but is instead driven by how people borrow money and lend money. This is really one of the ingredients that drives a lot of volatility in the financial markets. One of the things that really drives what happens to your investment portfolio over time. And one of the things that is absolutely critical if you're running a business, it is something that clearly defines whether you're able to borrow money at a reasonable rate, and it determines whether, when you're operating in international markets, for example, importing machinery from Germany, whether you're exposed to a lot of volatility in doing that. So just wanted to kind of start with a diagram that the hedge fund manager Ray Dalio developed many years ago. He said, essentially that if you look at economies in the very long run, productivity is the key determinant of whether the economy grows. So whether we're able to, invent new things and deploy those in the economy is really what drives the rise in living standards that we experience over time. That's what drives GDP up over the very long run. However, in the near term or in the shorter run, what we see is a set of dynamics driven by credit appetite, by whether investors are willing to lend out money, whether borrowers are willing to borrow that money, and therefore whether people are able to spend that money. So when lenders are able to or are happy to lend money, that money tends to flow out into the economy. It tends to be borrowed by consumers and businesses. Those consumers and businesses then spend the money, and that drives economic activity. And so, typically what we see is two cycles laid on top of each other. We see a very short-term cycle, usually lasting 5 to 8 years in length, in which we see, lenders get very, very optimistic. They lend lots of money out. Eventually, and that drives growth up. It drives GDP up. We see lots and lots of optimism about where the economy is going. And then we see some sort of shock or surprise that turns the tide, and those lenders begin to pull back. They start to, close the purse strings and lend less money out into the economy. When that happens, we start to see a bit of a downturn. We see investors or consumers and businesses spending less money and less activity happening in the economy, and therefore investors become even more cautious. And so typically we see an overshoot to the top side. So in other words, investors become too optimistic about the likelihood of being paid back. And then we see an undershoot to the downside, in which investors are too afraid to go out there and lend out money to businesses or consumers. And that cycle happens over and over and over at a relatively frequent pace. However, there's also a bigger, deeper cycle behind it. And that is what Dalio thinks of as the long-term debt cycle. So that is a cycle in which, for a generation or two, we see credit conditions steadily loosening. The lows are lower, the highs are higher. The lows are higher and the highs are higher over time, and debt grows and grows and grows. And as it does that, we see a big disconnect between the value of financial assets and the real economy. And so, I would argue that we have seen something like this over the last 40 years. We're going to talk a little bit about some of the drivers of that, but this is not the first time. We have seen this sort of cycle happen many, many times before. When it ends, it doesn't end with a big bang. There's not typically an enormous market crash or anything like that accompanies the end of it. But we start to see things sort of slow down and wind down, and we see a gradual dip into negative territory, in which businesses and consumers deleverage, and the value of capital appreciates much, much more slowly. So asset prices don't go up at the same rate, and economic activity typically slows down quite dramatically for a while. Now, this is a theoretical construct, but the Bank for International Settlements actually depicted it a few years ago, showing what had happened since 1970. And so what you can see here is the credit cycle in red plotted on top of GDP. So you can see that there are peaks and falls in GDP over time, but they're far, far smaller than what we see in the credit cycle. So this credit cycle is showing you how much credit is going into the economy, so how many loans are being made, and how much people are borrowing. It is showing also the value of real house prices on top of that. So what you're really looking at here is a really interesting dynamic at the end of the day. What you're looking at is how fast is money flowing into the economy. And I think that's sort of a key point as well to bring up before we get deeper into this. And that is that most of the money that flows through the global economy today, the vast majority of it is not printed by central banks. Central banks do not print very much of the money that people actually use. They do print actual banknotes, but those represent less than 1% of the outstanding value of currency. Most of the money that flows through the economy is created by commercial banks making loans. So when a commercial bank makes a business loan to you as an equipment dealer or to a household who is purchasing a home, that is creation of new money. And when that money goes out into the economy, it creates money supply. Money supply grows. When that loan is paid back, or the lender writes it off, that destroys money. And so we see this sort of cycle of credit being granted, paralleling what happens in the money supply side of things. So money supply expands a lot, when you see these peaks on the chart here, and contracts a bit when we see the bottom. So overall, what you're looking at is a financial cycle that does not necessarily match what is happening in the real economy, but does sometimes drive what happens in the real economy. If we see the financial cycle turning down or weakening, that is very, very likely to mean that we're going to see a slowdown in the real economy. So when you look at this chart, though, you are looking at one long-term credit cycle. So just to bring it back, if we go back to our prior chart, I would suggest that what we're seeing here is over that 40-year period depicted on the chart is this part of the cycle, this red part here, and the ups and downs are the swings around the median here. So you're looking at a cycle that is swinging around quite a bit, but it is not necessarily matching GDP. So let's talk a little bit about what might have put so much momentum behind the credit cycle in this case. And I would say the first thing to emphasize is technology. So this chart shows the number of mobile subscriptions in the world. This is, mostly smartphones that have been connected to the internet. We have now topped more than 8 billion more mobile subscriptions around the world. This really is sort of the tip of the iceberg in terms of all the communication technologies that have brought the world all together to talk to each other. So, suddenly people in sub-Saharan Africa can agree to deals with people in New York. People in, Mumbai are able to produce garments and ship them to cities in Canada. And the way that they can do all of this is by communicating through the internet. This is an unprecedented thing. Prior to this time in history, when people wanted to make these sort of cross-border deals, they had to talk to intermediaries. We had to have a long chain of intermediaries, each talking to each other and each doing things in a relatively inefficient way. So today we've seen a huge sort of quantum leap forward in terms of how people match demand and supply around the world. We've also seen a big shift in terms of the barriers to movement on the planet, and I think the biggest factor here, which is very recently in the news again, is the fall of the Soviet Union. When the Cold War ended, when the Iron Curtain fell, we suddenly had equivalently 1.3 billion people who re-entered the global economy. We had a huge influx of people that were suddenly able to participate in the global economy, suddenly able to trade with other people. That paired with reforms in China beginning under Deng Xiaoping really sort of revolutionized the number of people who were part of the global economy and who were traveling between different locations around the world. So, you had this sort of sudden mass movement of people across borders, people and ideas, and that was also paired with the fact that people were suddenly leading longer, more prosperous lives. The green revolution that happened in the 60s and 70s, all of the medical advances, they sort of piled on each other, and what they drove was a huge rise in the birth rate as well as longer life expectancies. And so what that meant was that between your 1960 through to 2005, we were adding hundreds of millions of people to the global workforce every 5 years. At one point, it was well over 350 million, who were added to the workforce in a very short order. And so this has very dramatic effects. This means that there are a lot more people producing something, and essentially that raises global productivity. But it was also the relationship with the elderly cohort that was very critical. So all of a sudden, for the first time, you really had this huge working age population who was able to support support seniors. And when the proportion of working people to seniors gets very high, we tend to see a rise in productivity. We tend to see a rise in economic growth. And that is what we saw. We saw a boom of absolutely historic proportions. And that really changed the world. And I think, the big thing that it impacted was the flow of trade. Here are imports and exports as a share of GDP, going from 1950, through to last year. And so essentially the share of goods and services that we consume tripled, that was produced internationally, tripled over that period of time. We became far more interconnected. The propensity for trading things across borders absolutely soared. And the entire global economy is better off for it. There were certainly people who lost out as this transition happened, but at the end of the day, it is a more efficient and productive way to run the global economy, and we've all reaped the benefits, an incredible amount of growth. That has also reduced global inequality. So by bringing all these people into the global economy, by allowing them to contribute in some way and to earn income, we have seen a sea change in global income levels. So, I won't go too far into what this chart shows, but essentially it shows that in 1800, most people in the world were very poor, earning between 50 cents and $1 a day. By 1975, we had a two-hump global economy in which the bulk of the world, like most of the people who lived in warmer countries in the world, were still earning around 50 cents to $1. And we had a rich population up in the Western countries that had done far better and was earning between $10 and $20 a day in inflation-adjusted terms. Now, 2019, like when we fast forward from 1975 to 2019, we have a massive improvement. Suddenly, most of the world is up in that $5 to $10 a day, and most people have been lifted out of extreme poverty. So, this is a fantastically good story. One thing that it brings with it, however, is the fact that within countries, people participated and benefited in different ways. So here's a chart to kind of depict how that works. In the United States, the income growth that we saw across the US population varied quite dramatically from 1980 through 2020. So the people at the bottom of the spectrum, the people in the bottom 5 percentiles or so, actually saw a decline in living standards because they were unskilled laborers in many cases. They worked on factory floors, they were laid off, and they were never reemployed. So very devastating consequences for them. Meanwhile, other folks in the US started tech companies, found billions of consumers to sell their services to, and earned billions of dollars. That pattern was also repeated in the developing world. And I put China up here as an example, but many other countries followed a similar path. So virtually everybody in China is far better off than they were in 1980. Living standards have soared beyond what I think most Chinese imagined was possible in 1980. However, people at the top, people who own factories, people who are part of the political establishment in China benefited far more than the average citizen. They were essentially able to harness cheap labor and to sell the product of that cheap labor to the world. And so what happened was that you suddenly had a pool of a large amount of money that was held by the elite in China and in other developing countries. And those elites thought, maybe I don't want to keep the money at home. Maybe I want to park it somewhere else where it is outside the reach of the local authorities, where my descendants can take advantage of it, and where I'm very unlikely to see a loss of my capital over time. So what we started to see was, elites in many of these countries taking their savings out of their home countries, sending it to the United States, depositing it in the bond markets, in the equity markets, or buying things like real estate, essentially to protect it against what might happen if political fortunes were to shift in their own countries. At the same time, entire countries executed something similar. So the United States, the English-speaking countries of the world, have been running huge deficits, really going back to the 80s. And what that means is that countries that are manufacturing goods or producing oil have been able to generate massive, massive surpluses. So they've been essentially exporting more products and services than they have been importing from the world. What that means is that they build up a stock of wealth that needs to be invested somewhere else. So that's the real key thing to think about here, is that if the United States is running a trade deficit, there is an offsetting accounting entry where the United States is essentially importing goods and exporting money. And on the other side of the equation, China, for example, is exporting goods and importing money. And when they do that, if they do not, they cannot spend that money domestically, or that's another import. So what happens is they turn the money around and they recycle it into US or Western financial markets. So what we're looking at here is Europe, the oil exporters, and the manufacturing countries of Asia exporting all of their surplus in capital terms into Western financial markets. So this is a huge, huge flow of cash that is essentially offsetting the flow of goods and services that is moving across borders. Central banks have been doing something very similar, some of them for deliberate reasons, some of them trying to intervene in currency markets and depress the value of their own currencies, others simply looking to establish safety. They've accumulated immense amounts of currency reserves, something like 12 trillion at the last measure, and most of that is parked in the US dollar or the euro. And so, and just to kind of touch on current events here, so Russia is one of the countries that was doing this, right? So Russia had built up, I believe, roughly 28% of GDP in currency reserves that were largely denominated in euro and a little bit in US dollars. And Western authorities just went and seized those. The idea, though, was that Russia thought that they were establishing sort of a rainy day fund, so that if we were ever to be at loggerheads, Russia would have sort of something to stabilize the economy. That turned out to be erroneous and incorrect. But it is the mindset that drove what you see in this chart. In other words, many of these countries building up these really big reserves. So over time, we saw flows into the United States really, really surge. And I hold out the US here because it's the biggest recipient. But the reality is that this flow has been moving into all Western countries to some extent, more so into countries like the UK, Canada, Australia, those with common law systems, with English common law systems and English speaking in general. But the US, what you can see here is kind of interesting. Ahead of the 2008 financial crisis, we had a huge flow of money from oil exporters around the world, from manufacturers into the US bond markets that drove down US bond yields. And that is what helped to trigger the 2008 financial crisis. In other words, this huge sort of credit bubble, this huge bid for US bonds helped to lower the cost of credit in the United States and helped to create the conditions for the housing market boom that we saw at that time. Now, after the crisis, it actually rebounded really quickly. We started to see the same sort of activity happening again. It wasn't until 2013, wasn't really till the taper tantrum in the US, when the US started to raise rates and emerging markets started to suffer a bit, that we saw any of that reverse. And just to kind of emphasize here, in early 2020, we saw a big sell-off in US bond markets. A lot of foreign investors sold bonds and bought equities. So what happened at that time was we saw a cycling out of people selling their treasury bonds and buying tech stocks. I think this was one of the biggest reasons we saw that huge surge in stocks for like, Facebook and Apple and all of those guys, while the Fed was buying treasuries at the bottom of the crisis there. So, we saw that. We then saw early last year a bit of a reversal. We started to see demand for bonds and for equities begin to fall off. But overall, this is a huge, huge determinant of what you see in U.S. financial markets. All of that is paired with what was happening domestically. And so this is one way to show this, but what I'm showing here is net assets of target date funds. And so target date funds are funds that essentially hold a certain proportion of bonds and a certain proportion of equities in order to target a given retirement year for the investor. And so, we can easily break the target mix down to determine what the target date for the investor is. And you can see that the bulk of the funds that we have currently in the system are targeted at that 2020 to 2040 retirement area. In other words, the baby boom generation has built up the bulk of the savings that are in the system. And because the baby boom was such a huge cohort or such a large number of people, this has had a distortionate effect on the U.S. Financial markets. In other words, this huge flow of cash has really been like a one-way flow of cash into the financial markets through the baby boom generation's peak earning years. In essence, as baby boom, generation people started to approach retirement or got into their 40s and 50s, they really started to build up those savings balances, and that money flowed into markets and helped to depress interest rates. Take all of that, put it together with the fact that central banks, whenever we have a crisis, have repeatedly intervened by buying assets. And you have, the ingredients for essentially a suppression of volatility over time, and a big bid for financial assets, all of which comes together to create amazingly, amazingly favorable conditions for banks who are lending out money. So here is money supply in the major economies going back to 2000. And you can see that virtually every major economy produced an incredible amount of money in a short period of time, with China far outstripping everybody else. China has created wealth created money at an incredible pace. So, the economic model that China has been using to sustain growth is arguably flawed at this point. They've essentially created so much credit that they've made the economy dependent upon it, and that is a major, major risk. But long story short, what has happened here is that this mix of demographic forces, technological forces, and the policy choices of economies has driven money supply to grow, and it's helped to suppress inflation. So, this is a chart going back to 1660. You can see that volatility has sort of narrowed over time or become minimized. The variance in prices has fallen. And at the end here, you can see this sort of long period of moderation in which inflation rates, at least in the developed world, have subsided substantially. I would suggest that this is very, very unusual. This is not a normal period in history. There was another period back here. You can see from roughly 1860 through 1910 that was very, very similar. Where the canals were open, telegraphs were installed, railways crisscrossed countries, the Bessemer steel engine was developed. All of these things were sort of put into play, and they also had that impact of suppressing volatility and creating a lot of wealth. But yeah, overall, what you're looking at is something sort of anomalous in history. And it is something that many participants in the global economy have become used to. Interest rates, following that whole process, following the fact that money is abundant and that investment opportunities are relatively limited, has plunged in value. Interest rates are in negative real territory right now. across the developed world, and that is, we've only seen it a few times prior in history that we've seen, interest rates sustain levels at this sort of threshold. So, if you take all that together, what it sort of means is that we've had a giant tide of capital flowing to the markets, lifting all boats. And as Warren Buffett likes to say, it's only when the tide goes out that you see who's been swimming naked. The challenge is what might happen next. And so, just to reference, where the risks are, we have global indebtedness that is now at unprecedented levels. So whether, you look at the household, corporate, or government sectors, anywhere basically in the developed world, we have never, ever seen debt levels this high. So there is a risk that if the money were to reverse, if that sort of flow of capital were to go back out, that some of those borrowers might find themselves in rough places. And the other issue is that because financial assets have so outperformed the real economy, that we might see downward pressure applied at some point if money starts to leave. So if investors start to take their money out to pay for retirement, if people start to deploy capital elsewhere, that would pose a pretty significant risk and would mean that potentially financial assets start to fall and converge with where GDP is. So we might see a sort of narrowing or a convergence between these two lines depicted on this chart. So just to kind of underline that, if we look at this chart, what we're showing is the value of household financial assets in the US relative to GDP. And you can see that, GDP or the ratio between financial assets and GDP was at a roughly 2.8% in 1950 and is at 4.9% now. So we've seen, this huge sort of outpacing of what's happening in the real economy in the financial markets. And that all ties back to that chart that I showed you at the beginning, where the credit cycle sort of moves up and beyond where we see the growth cycle itself. This is not abnormal in history. It has happened many times, but it has never happened to this extent. And just to kind of illustrate things as well, you can see two big blips here. One is in 2000, the dot-com boom. One is prior to the financial crisis in 2008. Well, really 2007 is where that peak is, and where we are now. You can see the early 2020 sell-off is basically not visible. At the end of the day, markets have gone to newer heights all the time, far, far beyond what we've seen in the real economy. And so that is where the risk is. So I'm just going to show you where that might change. First thing to kind of highlight is that the global demographic picture is shifting rapidly. And I know that this sort of sounds abstract. It's something that's big and slow. And I definitely understand where people would think it doesn't have a direct market impact. But the reality is that if we see Asia aging at the rate that it is, so that fewer and fewer people are working in businesses during the day and supporting elderly relatives. What we're going to see is sort of a drop in productivity in many of these sort of Asian giants, and I would say in particular in China. At some point, we're going to be seeing the working age population literally going negative and shrinking in Asia. It's already shrinking in China, but across Asia, it's going to begin to shrink. And the only region in the world where we have any hope of sort of offsetting that is Africa. But the problem is that Africa is, many, many states run by many, many different governments with different ideologies and different ideas. We do not have the unifying forces that were in place to help, Asia really industrialize over the last half century. We don't have the sort of coherent policies or education standards that we had that helped to propel those other areas of the world ahead. So Africa is very, very unlikely to be in a position to offset the losses that we see in Asia. Unfortunate, but quite true. And I should also point out that this is a fundamental issue, but it's also a perception issue. If people perceive that this demographic cliff is coming at them, they're going to adjust their investment preferences accordingly. And so I would be concerned as to what people see coming here. I would certainly think that many of these people are very concerned about what happens to the economy in the longer run. They're not nearly as optimistic as, Western commentators who think that China will supersede the US and become the world's largest economy right away. If you ask many people in China, they're definitely not of that opinion. They definitely have a more skeptical view of where the fundamentals are. Right, and old age dependency ratios are climbing as well. So virtually every region of the world is seeing the population of aged people over 65, growing very rapidly over time. And that means that the people who are younger are going to be called upon to support them. I would suggest that this has a couple of implications. One is that there are financial costs to supporting elderly relatives. Sorry. But there are also the issues related to people giving care. So caregivers being taken out of the workforce in order to care for elderly relatives or simply to work in care homes or other facilities is pretty substantial and is likely to grow over time. In fact, it's likely to grow almost exponentially as as people near the ends of their lives. So, as the biggest cohort of people moves from 70 to 80, the caregiving cost goes up very, very materially, and from 80 to 90, even more so. So, this is sort of a cascading impact that will happen over time. And it's one that will take people out of the workforce and limit the number of people who are available to fill the jobs that we have today. You are seeing some evidence of that right now, I think. So we have in this chart the ratio of quits to firings in the U.S. So in other words, how many jobs do people have relative? How many jobs are people quitting relative to getting fired from? This is, really a good indication as to whether the economy is running on all cylinders, whether, employers are willing to, fire people and look for better employees, all of that. And what you can see here is that we reached historic highs last year. We are not far off those highs right now. And, this is, of course, partially due to the stimulus packages that were deployed during the crisis. But I think it is also a reflection of deeper fundamental. And you can see that trend line from prior to the crisis or prior to the coronavirus hit, very, very clearly sloping upward, right? So I think ultimately what you're talking about here is a small but gradual and important reduction in the total workforce available in the United States. At the same time, we have incredibly interesting things, I guess, happening in the global geopolitical arena. Countries are suddenly willing and able to use economic weapons against each other. For decades, I think the only countries really deploying economic tools to achieve geopolitical goals were countries like China. So, for example, China was intervening in the currency markets, using its accumulation of currency reserves to influence the value of the renminbi or keep the yuan depressed and thereby subsidize its exports. The United States largely let it do that while it was going on. But all of a sudden you're seeing everyone else realize, wait a second, we're facing all of these countries that are, deploying tools like this, that are subsidizing some sectors, that are punishing other sectors. Maybe we should do some of the same stuff. And so on this chart, I'm depicting, the value of the ruble, which fell, 45% a couple of weeks ago in the space of a single day. And this happened when Western authorities decided to sanction the Russian central bank. So when they said to Russia, you cannot use all of those foreign exchange reserves that you built up in US dollars and euro, that caused a plunge in the ruble. And I think it was sort of a warning shot to many emerging markets saying, maybe these reserves that you're building up are not as safe as you think they are. And I think this is a sign of things to come. It won't just be Russia at the end of the day that this gets deployed against. We will see the use of these tools elsewhere, and we'll also see countries becoming more interventionist in their economies over time. Geopolitical risks are growing along with that, and I think we're going to see sort of a sustained increase in geopolitical risk over time. That means a lot more uncertainty for businesses that operate across borders. It also means that money will not flow across borders as smoothly as it has for a generation. Commodity prices are rising along with this process. So, not only are we seeing actual supply disruptions across the global economy, but we're seeing financial markets take out insurance against supply disruptions. And so that is forcing prices up. And that means that we're seeing a higher level of background inflation than we have experienced in a very, very long time. Shipping costs are still elevated and are likely to remain elevated for quite a while yet. Although we have seen a bit of a downturn here, the reality is that the cost of shipping from China has risen spectacularly and is nowhere near pre-crisis levels. So, we could be looking at something that keeps prices elevated for a while. All of that is happening while interest rates remain in deeply negative territory. So when we look at the difference between the inflation-adjusted policy rate and core inflation rates, that gap is as big as it's been since the 70s. And in the 70s, it took us almost a decade really to sort things out for interest rates to come back up and for inflation to come back down and sort of normalize. And you can see that we saw pretty extreme swings here in the Fed funds rate at that time, and eventually we started to achieve sort of some semblance of normality, but it could take a while. And so ultimately, what you're looking at here is still a very accommodative financial backdrop, but one that is being endangered by this high inflation rate. Inflation expectations are climbing as well. So, although we look at that backdrop and concern ourselves about where inflation is going, the reality is markets were not that concerned until about a month ago. We suddenly saw a spike up in concern about where inflation was going in both Germany and the U.S., sort of our big bellwethers for the global economy. And virtually everyone expects that we're going to see extremely high inflation over the next 2 years and relatively high rates over the next decade. So, this is the backdrop that policymakers are operating against. Suddenly, it is not popular for a politician to spend money. Through early 2020, governments could spend lots and lots of money. Mr. Trump had a lot of fun spending money. Biden came in, spent some more money. Politicians around the world did the same thing. It is no longer popular. It is, sort of political suicide to suggest that you should widen deficits and spend more money because people are concerned about this inflationary risk. So government stimulus is winding down. Arguably has actually gone negative. If you look at the net flow of cash from the federal government into the U.S. economy, it went negative in around May or June last year. In other words, more taxes were being taken out than money was being put in, and it is likely to remain firmly negative this year. So, that means that the flow of cash coming into the markets is not going to come from the federal government level, at least. Asset purchases are slowing. Central banks have pulled back and have said, just in the last few days, the Bank of England, the ECB, the Fed have all said that they want to step back from the markets and stop investing, in bonds and mortgage-backed securities and things like that. So we're seeing, that flow of cash being turned off. Policy rates are rising. We're seeing a rise in the GDP-weighted policy rate. Very modest so far, but we're starting to see it climb up. And markets expect a much more aggressive path in the months ahead. So this chart depicts the number of hikes that are expected by the end of this year. And you can see that we've sort of seen a sea change since June last year, but one that accelerated early this year. So Suddenly, we now expect another 6 interest rate hikes, essentially a hike at every Fed meeting between now and the end of the year. And we expect rates to continue climbing into 2023. Problem with all of this is that, tighter policy is great. Interest rates going up is very, very painful for those carrying a lot of debt. And so if we look at this chart, what we're seeing here is the debt to GDP ratio across the advanced economies relative to the emerging market economies. You can see that the advanced economies are currently carrying more debt than they did after the Second World War. And just to kind of underline that again, after the Second World War, we had the baby boom generation. We had a huge demographic boost. We do not have that this time. This is potentially quite threatening when we couple it with higher interest rates. Borrowing costs are set to climb. In the US, I would say that the US is one of the more sheltered economies in the world in terms of where households are at. Households have deleveraged since 2008 and are not carrying as much debt, but other countries are very, very much in the danger zone, including my own country, Canada. So Canada is extremely leveraged. We've had a housing boom that makes the 2008 one in the US look downright amateur by comparison. So lots and lots of debt, but this, as interest rates climb, that could mean that we see lower and lower levels of consumer consumption coming along with that. Markets are deflating as we go to print today. And I think a large part of that is market participants anticipating tighter money in the future. Money supply growth is falling overall. And so that's, sort of the second to last chart I'll leave you with is to show you that, that growth in money supply is beginning to fade. Credit into the global economy is slowing. This is likely to represent a headwind for financial assets. Overall, just kind of sum all of that up, you're looking at potentially higher borrowing costs. I do not think you're looking at interest rates that look anything like the 80s. However, debt levels are higher this time. So the pain that is inflicted by rising rates could be just as significant. We could be looking at slower asset price appreciation. So, home prices not going up at the rates that they have, equities slowing down and suffering to some extent. All of that happening against a background of higher wages, especially higher real wages. So, we could be seeing sort of a redistribution of capital in the US economy, in the global economy, from the owners of capital to the workers. If we do see that, if we do see, labor markets tighten and sort of an incentive shift, then we could see more investment. We could see businesses investing to automate their processes, to bring in new technologies that minimize the sort of man hours needed to execute processes. All of that. If we do see that, we could see a boost in productivity over time. So we could see the U.S. suddenly jump out of that productivity slump that it's been in, and the economy itself perform relatively well. So the funny part here is that we might be looking at a slowdown in the financial markets and an acceleration in underlying productivity that helps the economy to grow more quickly in the future. And I think that that's sort of the key message here is that, if we look back over the last 2,000 years, and we break down growth across centuries, it's very obvious that the most volatile periods in human history around the 15th and 16th century here, helped to put the conditions in place for the boom. So, we had the Black Death, we had the printing press, we had all of these things sort of come together, some of them positive, some of them negative. But what they combined to do was to disrupt how society worked and help to put the conditions in place for a big acceleration. So if I break it down, the amount of GDP generated in the 20th century was equivalent to 40.9% of all the GDP generated in the last 2,000 years. And the growth that we've seen in the last 20 years is equivalent to 45.9%. So huge acceleration in growth because we have a bigger human population living longer, happier, healthier lives, producing more, and and accelerating that growth. So the fundamental message I kind of wanted to leave you with is that that this disruption is likely positive in the long run. Orson Welles put it pretty well. He said in Italy for 30 years under the Borgia, they had warfare, terror, murder, and bloodshed, but they produced Michelangelo, Leonardo da Vinci, and the Renaissance. In Switzerland, they had brotherly love. They had 500 years of democracy and peace. And what did they produce? The cuckoo clock. The point is, a lot of this disruption is likely good for us in the long run. We should probably welcome the volatility that we're seeing, and try to keep our heads as all about us are losing theirs. With that, I'll just put up my email address here. If you would like a copy of today's presentation, please shoot me a note, and I would be happy to send that over to you. Thank you very much.
All right. Thank you, Karl. Just a reminder to everyone, if you have any questions, you can submit them by clicking on that Q&A icon. I guess one question would be on the slide you had comparing the number of firings to quitting. Does that quitting number include things like people who are retiring and just leaving the workforce in that regard? Or is it they quit this job and they're going to a new job?
Yeah, it's a quitting. So they do break out the number who are actually retiring, and that has risen quite dramatically through the crisis, but it is not included on that chart.
Okay.
Yeah. So, and I should say that's been one of the biggest drivers, I think, of the decline in participation and labor market participation is the fact that the people retiring right now have seen a huge boost in the level of wealth that they have. As markets have gone up, as home values have gone up, they have felt much safer and much more comfortable with retiring early. The flaw to a lot of it right now is we can't get really great data on who's retiring for what reason.
Okay, that sort of, I guess, answers my follow-up was going to be, did we see that people were retiring earlier than typical, kind of on the heels of all the COVID stuff, but I think you sort of said it's hard to tell.
No, we definitely did see that, no question. So, and I'm trying to think if I can put an exact number on it. So I know that that we did, especially in the first year of the pandemic, the early retirement level was like roughly double what it had been prior. And so, people were absolutely taking the pension and walking out the door. And then once the rebound really started, so last year, we started to see another wave of early retirements hitting. So yeah, and that's been a phenomena across the developed economies, not just in the US. The US participation rate came back much less aggressively than we saw elsewhere, but it's definitely happened throughout the world.
Okay. And then even with all the inflation going on, is it your opinion that businesses should stay cash heavy for the next couple of years?
Right. So I would say that that's an excellent question. And it's not really a simple one. I think the thing that we want to look at is what returns you can get and what the risks are of leverage. So it's not necessarily that you want to be cash heavy, but you do want to be investing in the business itself. You don't want to be taking out a lot of leverage in this environment. And that's a real challenge because lenders right now are shoveling the cash at you. And yeah, if you're on the equipment side, it's can you invest in a way that helps to grow the business? If you can, then you want to invest in that area. But the other thing to kind of think of is, I forget how Warren Buffett put it. He said it like, way more pithily than I'm going to say it. But he said that, every decade or so, the sky turns gray and the sky starts pouring and, it starts pouring gold from the skies. And so you want to be in a position to run out there with a wash tub. And so, the key here is, and his strategy always is to preserve as much optionality as you can. And that cash does give you the optionality. It gives you the capacity to jump on opportunities when they come up. So yeah, a relatively higher cash allocation, but don't go straight to cash.
All right. Those were the only ones that have come in so far. We do have time for probably one or two more questions if anyone had anything else they wanted to ask Karl.
The one irony of this is that we're doing it on St. Paddy's Day. So there's like one cohort of people that are probably at the pub already, and the other are not too confident about their typing skills right now. So we'll give everyone a pass.
All right, fair enough. Well, one just come in. So do you see less support for farm payments and subsidies going forward?
Yes. Yeah, I think the challenge is that I think governments are going to have a harder time justifying any spending for a while. That said, it depends on what happens in Washington to a very big degree. Depends on like which way the political winds are blowing. The challenge is, like, I think governments are going to be far more interventionist. They're going to be playing a bigger role in the economy, but actually giving out handouts is going to be the difficult thing. I don't think that you're going to see as much support, unfortunately. It'll depend on whose lobby is more powerful for a while. That's and the other big challenge, of course, is that given background commodity price levels, right, the fact that we've seen these huge increases in prices for most commodities, it is going to be a difficult sell. It's going to be very difficult to justify spending to the average consumer if those prices are sustained. Okay.
And then in the next 1 to 3 years, you see the residential market in worse shape than the ag market?
So like, I'm not sure, residential, like the residential real estate market, maybe? I'm not sure. Or agricultural land versus, yeah, okay, that might make more sense. Sorry, I'm a little slow off the, yes. So, clearly we are looking at big inflows into the commodity complex, and people are going to be looking to invest in farmland for sure. The question is just, how long that current boost goes. How do I put it? So farmland has seen really rapid appreciation. If you look north of the border, it's like off the charts in Canada. So you have room to catch up a bit. But so I would personally be more biased toward farmland. Yeah.
They did post a follow clarification that they said consumer turf. So I guess they would say the meaning, I guess, who's going to be spending more, maybe? Is it more on that residential side, residential consumer side versus, farmers and producers needing to buy equipment?
Oh, okay. Now, I have to think about that. Yeah. I mean, it would be sort of absurd if we saw consumers continue to spend like they have been. Like the building material side of things is crazy. And I do think that was largely a function of people being trapped at home. If we don't see softness coming out of this, that would be an absolute shock. So I mean, yeah, I would definitely bet on the commercial side if I'm interpreting the question correctly, and I assume that that the person asking the question is thinking like that. So I guess what is priced in right now is probably softness, but I would expect even more softness in the consumer segment. Like, people have not suddenly changed their spots. They're going to go back to work. Spending patterns are going to shift. We're going to see more spending on travel, less on actual tangible goods. Mm-hmm. All of that is, likely to put some downward pressure on what we see on the building material side.
All right. And with that, we are just at about the top of the hour, so we will wrap things up. Just as I said earlier, today's presentation and audio will be available on the Farm Equipment website in the event you want to go back and review it. Watch your email and the Farm Equipment newsletter for more information on when that's available. On behalf of Karl, the WIDA team, and the Farm Equipment staff, thank you for joining us for today's webinar. There'll be a short survey that pops up once you leave. Let us know what you thought, and you can always reach out to me directly with any topics you'd like us to cover in the future. Thanks again, everyone, and enjoy the rest of your day.
Thank you.